unicorn, small, independent, focused investment management business, currently managing assets just north of £1 billion across a range of 9 different funds. We're independently owned. We're very much focused on the UK equity market at the small to mid-cap end of the market, and we're long-term investors. We like to identify businesses that we have a high degree of confidence in and partner with them over the long term. It is new for us. We only launched our IHT portfolio service in November 2015. And it came about as a consequence of some of the changes, obviously, to AIM holding rules, in particular the allowance to hold AIM stocks in ISAs. We've been managing a successful AIM-focused VCT for 16 years now, and this was very much a natural extension of what we already do. In effect, we were getting increasing levels of demand from IFAs, in particular, asking whether or not we would consider launching an IHT service. Ultimately, it's still quite small. We have no intention of aggressively marketing it. We manage about 300 million of the total under management is in AIM stocks, and we believe we've built up a wealth of experience in what can be a pretty tricky area to invest. In terms of the kinds of businesses we look for, I make no apologies for looking to invest in established, profitable, cash generative, some might even say boring businesses. They tend to operate in specialist niches where they can protect their margins, have some sort of competitive advantage, and where we can see a direction of travel, a sustainability over growth over several years. Ultimately, we very definitely migrate those successful businesses held within our AIM focused VCT and increasingly in future from the IHT into our mainstream open-ended funds. Well, we're generally speaking sector agnostic, but it's easiest to answer that question by saying, telling you the sectors we don't invest in. And they are quite simply sectors we don't understand or like. So you won't see us investing in junior oil and gas mining companies, in biotechs, in early stage startups. By definition, for a business to be profitable and cash generative, it has to have been around for some time in order to get there. And what we're trying to do is effectively minimize the risk and ally that to the deepest possible understanding of the business that we can muster. You'll probably be unsurprised to hear that a good number of the holdings within both our growth inheritance tax portfolio and our income inheritance tax portfolio are derived of stocks that we already know really well, that are owned within our AIM focused VCT. And so you're talking about businesses from the really very substantial, like Abcam, for instance. Abcam's now a £1.2 billion business, but it's a business that Unicorn first invested in when it floated back in November 2005, well over 10 years ago. We've held it ever since in the Venture Capital Trust, and it makes perfect sense for us to hold that within the IHT portfolios. At the other end of the spectrum, smaller businesses, but businesses where we have really strong relationships with either the founder or the management team. So I'd point to a business like Crawshaw, very simple business that is effectively a chain of retail butchers, but very cleverly has put a twist on that where it does hot food to go. So think of it potentially like a Greggs of the future. It currently has 40 stores. It's rolling out organically. It has plenty of cash on the balance sheet. Every single of the stores that it currently runs is profitable at unit level. And so the growth is self-funding through the cash flow within the existing business. The common perception is that most AIM stocks don't pay dividends because they don't generate sufficient cash flow to allow that. And that's probably true. Our filtering process pretty much immediately knocks out 700 to 800 of the 1,100 companies listed on AIM. But it's fascinating because of business property relief and because there are a number of management teams who recognize the tax benefits of that business property relief and choose actively to retain an equity stake in their business when they list, they're going to naturally be inclined to choose AIM as the index of choice. And as a result, I tend to characterize that as the blue chip of AIM. And effectively, there are probably 100 businesses out there listed on AIM that are potential candidates for inclusion in our income portfolio. Of those, we run high conviction portfolios, so typically no more than 30 holdings in either of our IHT portfolios. Well, we're targeting an initial yield of 3% within a range of 2 to 4%. The first thing I'd say is acceptance of failure is a prerequisite for successful fund management. The ability to recognize that with the best will in the world, we will never get it right all the time is important. And sure, we have our fair share of failures. And what I always say to the team is the one thing when we get something wrong is to understand where we went wrong and to learn from those mistakes and to try not to repeat them. Ultimately, if you're asking me what's to give you recent examples of things that haven't worked out as we'd planned, of course, the IHT portfolio has only been around for 6 months, and so we, touch wood, have not got any examples from that. But if I take the VCT, as I say, I've been managing that for well over 10 years now, and of course there have been businesses that have gone horribly wrong, and to capture that in a nutshell, it boils down to cash flow and poor management. Cash flow in particular. I mean, there's a stat out there, well-known stat, that 95% of all businesses fail within the first 5 years because they're not generating cash. And so it's a mantra for us at Unicorn: focus on the cash flow statement. And where we've got it wrong, clearly it's normally because we've underestimated how much it'll cost them to invest in growth to get to profitability. At the moment, I don't see a bubble at all. In fact, the valuation gap between large caps and small caps, including AIM, has widened to a relatively extreme level, not seen actually since the last seen in the financial crisis of 2008. And what was fascinating for us in the aftermath of the financial crisis and the subsequent recession was a lot of our businesses, and I'm talking in particular within our VCT, because of course we didn't have the IHT service available then, was that they really had to hunker down to survive. It meant cutting out cost, it meant shedding people painfully in some cases, focusing on cash flow, doing the basics right, and right shaping their businesses for tough times ahead. Now, the purpose of all of that was because we were in a very low growth environment. Sales, if anything, were in decline, and therefore in order to manage that sort of top line decline, you have to really look after your costs. Well, it's only been in the last couple of years that we've seen a general return in demand for the products and services from the companies we have investments in. And that's really encouraging, because you get 5% increase in the top line when you're running an operationally efficient and a cost lean business. The operational gearing impact of that tends to mean that a lot of that falls into the profit and converts to cash. And we believe that the UK economy is in reasonable shape. Our businesses, by and large, are in terrific shape. I'd argue quite strongly in better shape than they have been at any point in the last 10 years. And that there's a chance that actually the wider analyst community are underestimating that strength in terms of their future potential to deliver earnings growth for all those reasons. And what that really means in a roundabout way is I'm relatively relaxed about the bubble question, because I have a high degree of confidence in the businesses that we invest in over the next few years, delivering the earnings growth that will support the valuation case. We are fundamentally risk averse at Unicorn. For what it's worth, we own a majority stake in the business itself, but more importantly, perhaps, we all put our own money into the funds that we manage. As you rightly point out, it's all very well having attractive tax breaks, but if the manager does a bad job, then frankly, there's no point. And so capital preservation is hugely important to us. We take a very risk-averse approach, as I've said. We believe that 30 stocks in a portfolio also offers significant diversification in terms of stock-specific risk, and therefore we will do everything we can to invest in sensible, profitable, cash-generative businesses that add value over the long term rather than destroy it. Clearly no guarantees in life, but you're much more likely to achieve sensible returns if you're investing in sensible, profitable businesses. Ultimately, in terms of trust, it's a subjective judgment, and I always urge anyone considering investment in any IHT product, and certainly ours, to do their own due diligence on the fund, on the management team, to look over the track record of their established funds, to try and investigate the backgrounds of the team involved and what their philosophy is. Ultimately, there's a wealth of information out there on the internet as well, and my biggest piece of advice to someone is, if you're thinking of doing it, if you possibly can, wait a few months. If you've listened to this video, for instance, see whether or not the manager is delivering to the message that they're giving, and build the confidence that way.